Well, all right, let's get started. Today's Middle Class Investor is being recorded on, what is the date today? The 9th of August. And we're about 40 minutes after the market close. And you can see so far this pattern that we had on the chart has been working out pretty good. I still think we're going to come down a little further or farther. I guess it's farther. Before we get we've already got a significant bounce. I mean, it's just amazing how big this bounce is. But looks like we closed the gap. Well, we closed the gap on the weekly. Let's look at the daily, because sometimes these gaps are pretty important. Yep, the gap on the daily has also been closed. So I would expect the selling to continue and come down into this area. Now, it's possible, so this move down could be a couple of different scenarios. It could be kind of an A, B, C, or it could be more of a like a 1, 2, 3, 4, 5. To me, it's looking more like an ABC, but we have gotten a pretty good bounce here right off the recent lows. So bottom line is it's going to move down into this area for the lower part of this channel where these lines roughly intersect around 2250. So from here, from where we closed today, we're looking at about 23% down. Okay, and that's maybe roughly, let's see what that is from the highs. From the high of this move down to there is about almost 26%. So, we talked about maybe taking some risk off the table when you started bouncing around up here, that we were at resistance. We had this box drawn on here, and quite a bit of resistance. Excuse me, up there. And that's hard. That's a hard thing for people to do. So I wouldn't be surprised if nobody did it. But you can see we got a pivot here, and this pivot created this DP here, and we chopped around inside of it, and then gave up the ghost and rolled over. So we got another pivot here. So there'll be this intersection down here is going to be about where this box is. So. Sorry about the coughing. I got something's dry in my throat, but we'll get through it. So I would just look for the S&P. We may get a little bit more bounce on Monday, and then roll over. If you look at this on a much shorter term basis, let's say an hourly chart or something like that. Well, that's too short. I guess I don't want to look at, on this chart, I don't want to look at that real short term because it's too choppy. But we could look at the futures, and it looks like maybe you might get a little bounce on the open and then potentially roll over and start going lower. But it could be that this is a 1, and then we're going to have a 2, we're going to finish 2, and then 3 could bring us down, down here somewhere, and then another rally, and then 4 and 5 into this area. So, I don't know. It's going to be exciting. It's going to be, there's probably going to be a lot of, my guess is the Democrats will really jump on it and start throwing some fear and doubt in there. Like, well, maybe this economy is not as good as we think it is, which I think is true. It's probably not. But about that time, it'll bounce and start coming back up, and they'll have egg on their face. I mean, that's pretty much how that works. If you really spend a lot of time studying the markets, what you'll learn is that news can make something happen in a day, but it generally doesn't have anything to do with the trend. So, for example, this day right here, this week, it's really not a week. I mean, it is a week, but you normally don't see news affecting a whole week. It more or less affects a day here and there. But sometimes you'll have some like an oversold condition or an overbought condition that'll be brought on by some news. But that's about it. You don't really get trend changes. These like a trend from this trend to that with news. News might be the catalyst, but the news really wasn't enough to make it go all the way down to here. This is just how trading and investing works. All right. I think that's all I want to say about that. Let's look at the volatility index. You can see that volatility spiked right here, ran up, but then it quickly came back in. And this is where, and I still struggle with this. You know, I had some options, 5 contracts, so 500. I was controlling 500 shares, and I thought about selling them up in here because of this volatility. You know, once volatility collapses, you know that affects the price of your options. So, just kind of give you an idea. This move down from here to here was about 2/3 of the value of my options. So 2/3 went away. Now, you know, it could come back, but you can see how this works. I mean, here was a spike in volatility, and then it came in. It came back, but not quite as high. Same here. So this move may or may not generate a higher volatility spike. The reason I'm holding these options is I do think, I mean, it may go like this, you know, kind of deal, and these are longer term options, but I think eventually it will spike. And when I say eventually, I mean in the next, I think before probably Thanksgiving, we're gonna see a spike even higher, maybe even sooner. So I went ahead and held them, but I could have just as easily sold them here and then bought them back, you know, down in here somewhere and save myself some money, make some money, you know, take some money off the table and come back into the market. It's tricky, you know, with directional options. You got to be really decisive, and it's hard to be decisive in the market. It's just one of those things. All right, let's look at the 10-year yield. So we had a real spike low this week. Could be the bottom, you know. I was going to zoom in, but I don't think I want to zoom in using that. I think I want to zoom in using this. You know, the bottom's back here with this blue line, so I'll mark that. Just real interesting how the bond market, I mean, really sold off quickly here. Here's that blue line, which I'm going to make red. And this is the old low, okay, which we were calling an important low. And then we had this whole sell-off, you know, back into toward this low. If next week, so I'm just going to say, if next week we get a candle, let's say we close something like that, where the close is up here. If that happens, then I'm going to say with a fair degree of certainty, this move is over. Now, it's likely, because this doesn't look complete. I mean, usually you'll get some kind of like this, you know, some sort of like, in other words, something that looks kind of like this, but down here. This is just another degree of this is a 4. Okay. So this is a 3. So 3, 4, and then when this finishes, this will be 5. But you can see here there's a 1, 2, 3, 4, 5. There should be another 4. Of course, it'll be a different degree of trend, so it wouldn't be the same kind of 4. It'd be like a 4, like a Roman numeral 4 or something like that. And then a 5, Roman numeral 5. So it's a smaller degree of trend, smaller than the overall degree of trend. But that's the way Elliott wave stuff is. It's what's the word? It's a fractal. It's fractal in nature. So you can kind of see a 1, 2, 3, 4, 5 here, where 5 extended. So this was just 1 right here, down to here was just 1. And then 2, 3, 4, 5. So if this is right, we should have another 4, a 4, and then a 5. The question is that 5 going to take out this low? And I don't know the answer to that. We've broken below this support area though, so usually if you get 2 consecutive closes kind of below this box, like if next week we get a candle that looks like it's down here, then I'm going to say this is probably going to go all the way to the bottom. We're going to get a new low, which means we don't have an important low in the bond market, which is weird because this very much looks it doesn't look like an ABC to me. It looks more, well, I mean, you could say this is A, B, C, with C being 1, 2, 3, 4, 5. But I don't know. To me, I thought this was more of a 1, 2, 3, 4, 5. So the first move off the bottom. But if we're going to have a new low, that means the rates going up in the bond market. It's going to take a little longer than I originally have been talking about on this YouTube channel. So it's going to be real critical to see if this is complete or nearly complete, or if it's going to continue down below this low. So we'll keep a close eye on that. That makes a huge difference in what we're seeing. Now, in the context of where the S&P 500 is, it makes a lot of sense actually that this is maybe an ABC, and then we've got this last move into new lows. Let's just back up a little bit here and see what it looks like on a 10-year. Yeah, see, it just, to me, this looks, let's go back even further. I don't know. To me, this looks complete right here. Looks more complete, and this looks like, initial move off the bottom. So I don't know for sure. It's hard to say. That's the challenge of trading markets. What I would do if I was going to be long yields, if we started to move off of this, I would get long yields and try to hang on to them and pick out a swing low where I was going to get out. So for example, let's just talk through this for a second. Let's say we get a candle. Let's say we get a candle that looks like this, and then we get another candle the next week that looks like this. Well, to me, this is an entry. So you enter here, and you let it play out. And once it makes a new low, if it makes a higher low, so this is a higher low, you stay in. Now it may do this and then turn around, but that's still a higher low than this low. So you stay in, maybe it gets really steep, I don't know. But I don't think you wait to see if it makes a new low before you get in, because it may not make a new low, and then you kind of defeated the purpose about getting in at good prices. So it's your money though. You do what you want. Just as a reminder, as yields go up, the bond prices that make up these yields goes down. So again, as a reminder, if you have a bond fund in your 401k, in other words, you have a group of bonds with different maturity dates all grouped into your 401k bond fund, that is just, if yields go up, the value of that fund goes down. There are no maturities. There's no maturity date on your bond fund. So there's no holding it to maturity and getting your money back. It's just it's a perpetual, I don't know what the formula is, but bottom line is they somehow figure it out every day, and over time, if your interest rates go up, the value of the bond fund is going down. So you just got to keep that in mind. It's different when you go out and buy a bond. If you buy a $100 bond, let's say you buy a 2-year bond, and let's say you buy it for $65, and you hold it for 2 years, it's going to be worth $100. Even if the rates were going down, even if yields were going down, if interest rates were going down, you'd be paid a lower yield each month. But if you held the bond to maturity, i.e. 2 years, you will get $100 out of it. A bond fund does not work that way. It's only, it goes up or down based on if interest rates are going up, the value of the bond fund goes down. If interest rates are going down, the value of the bond fund goes up. So just keep that in mind if you got bonds in your 401k. All right. Let's see. We didn't look at the 13-week Treasury, so let's look at that. As you know, the Fed lowered rates a 1/4 point, which we anticipated they probably would once we broke out of this tight range that was here at the top of this move. And probably what's going to happen is we're going to find some new low here, and then rates are going to take off to the upside, and the Fed's going to be caught, in this quote unquote interest rate cutting cycle. So they're going to be trying to cut as the market rates are taken off, and they're going to get all discombobulated out of that probably. Okay. All right. Let's look at Germany. There's really not much has changed in these markets since the last time we looked. Japan, same thing. They've all kind of, the UK is looking a little weaker now than it was. So there's let's see what this Bloomberg high yield is. So this is a high yield bond ETF, and of course as interest rates have been falling, this has been going up. But notice it kind of looks like a 5-wave move, right? 1, 2, 3, 4, 5, and then kind of ABC, and then 1, 2, 3, 4, and 5. So, normally what happens after a 5-wave move is you get back down here to at least the 4th wave low, which would bring us back to 2012 prices in bonds. So, that's wiping out a lot of time, a lot of investment time. So, and that's if the trend is going to continue upward, which it likely won't. That'll be the first move, and then we'll have a rally, and then we'll have another move, probably all the way back down to here. On high yield. So just keep an eye on that bond fund. I really think there's a lot of risk there, and I hate to see people lose a ton of money there, especially when it's been giving us some warnings for some time now. All right, I'll put this on a weekly so we can see it on a weekly. This is the S&P 500 futures. And I just wanted to step back and take a look at a bigger picture of the futures, and you can see here we've had this run up into 3. We got kind of an A, B, C, D, and now E starting down here. So it could be that E is starting, or this could be kind of a topping process where we could start the next wave down. I think it's probably the former. It's probably we're going to see wave E, and I don't really have any argument for one or the other than the fact to say that that's what Elliott Wave International is forecasting. Again, we got this little this little pivot under here. So, we might see this rally early next week and then just start falling. It should stop here, but of course it doesn't have to. It could just do this and then all the way down like that. So, but we're expecting it to hit the X down here. X marks the spot, and then that would be the end of wave E and of larger degree wave 4, and then then we'd have some rally up into new highs. Okay, this is probably, it's hard to say how long this is all going to take, but I would say this is going to take at least as long as this, maybe longer. So we could go back and measure how much time that took and maybe multiply it by 1.5 or something like that. Let's just do that, but let's do it on the other. Let's do it right here. Let me get off a month. Let's go to 5 year. So let's just measure from, I guess we'll measure from here just to be conservative. So from here to the low, that's 20%, and that took 98 days. So let's just say that, let's just say this took 150. Okay, maybe it doesn't take that long. Maybe it does. Not really sure. But let's just say, well, 147 days would be, what would that be? Where's the date? I'm not seeing the date. That's weird. Well, just looking at it here, it looks like mid-December. So you could, this is the thing about the market, right? We're coming in, if you listen to the news, we're coming into a seasonally good time for the market. Well, wouldn't it just be just like the market to, just like it did last year, the whole Santa Claus rally just didn't pan out, right? And then we bottomed literally on Christmas Eve or something and rallied. So, I mean, it could be that we have this kind of a similar effect, that we just kind of fall into December, into mid to late December, and then boom, rally and really rocket out of here with some, something good happening in the economy. And then I could totally see, this market making a new high, kind of on the eve of second Tuesday in November, and the Democrats lose again, and then the market just crashes, just heads down from there. I don't think there's any way the Democrats are going to win, even if the market sells off a little bit into here, because they're just I'll be right up front. I'm a libertarian. I'm not a Republican or a Democrat. I didn't vote for Trump. I like him better than Hillary Clinton, only because I think he was going to be better about keeping us out of an additional war. I'm thinking, my thing is we need to get out of all these wars. It's making us poor, and it's killing our guys, and some of them, they're coming home sick and can't function in our society. And to me, that's my biggest deal. But this game that the Democrats are playing with, there was racism everywhere, and everybody's out to get you, and there's institutional racism. I mean, I just don't see it. I go outside every day and I don't see that. So I don't know what they're talking about. I think most people don't know what they're talking about, and I don't know what their strategy is, but I can't in a million years believe it's going to work. So I fully expect Trump to, unless they change what they're doing, I fully expect him to win a second term. And I could totally see just heading into this, and then maybe after the first of the year rallying, and then, maybe spend all year rallying just about. And then, when the election comes, it just sells off again, because everybody, the people with money, a lot of people with money are Democrats. I mean, it's just the reality. And the reason that is, by the way, I have an opinion on that if you care. The reason that is because if you have a lot of money, you likely own a business or something, and you're all for the status quo. You don't want change. So you don't want things getting disrupted. And the Democrats are better at that. They're better at, cronyism and nailing things down and eliminating competition. Well, if you've already climbed the ladder, that's your goal, right? I mean, that's what some of these people aren't really capitalists. They're not really free market people. Warren Buffett is out there. He thinks everybody's taxes should go up. Well, he's already rich. What does he care? He's climbed the ladder. Now he's trying to pull it up so that the rest of us can't climb it. I mean, that's essentially what he's doing. So they're just better at that status quo thing. Whereas the Republicans, I don't know, they tend to say no to a lot of things. They're fighting for a lot of things, but because they don't have any principles, at least in my opinion, they don't really ever make meaningful change in the government. So anyway, that's a little bit of politics there for you. I'm enjoying all this politics, but I don't enjoy hearing people talk about race and hate and all this kind of stuff, because for one thing, I just don't see it. So I don't know what they're seeing, but I don't see it. And I'm out and about quite a bit. So maybe Texas is just special. Maybe we just don't have that in Texas. I don't know. Anyway, back to the markets. So let's look at some of the other stuff. We'll look at what can we look at? We can look at gold, since we're already on gold. So you can see the big picture here on gold is we're expecting, this is, again, if you go back, well, I can't go all the way back, but the bull market in gold started in 1999, had this huge run up, and now we're having this huge correction, which should take us back down to this fourth wave low, below $700. So, all along in here, I've been advocating buying gold if you can buy it at the right time. Obviously, if you could wait till here to buy it, that's great. But I've talked about on here about potentially some issues with that. I mean, gold, who knows, could be illegal to buy by the time we get to here. I don't even know. It might be that the U.S. government confiscates gold again, like they did in the 40s. I don't know. You never know. You don't know the future. Okay. Even though we have a good idea, or we've got a model for kind of planning where price is going to go, this doesn't really tell us what the government might do. And the government has done things in the past that harm people, making, shutting down the banks and forcing all Americans to turn over their gold and eliminating the gold clause out of all contracts hurt Americans. Okay, there's no doubt about it. In 1933, that led us to massive inflation. Nixon taking us off the gold standard in 1971, August 1971, no doubt about it, has hurt the people. In fact, let's just for grins and giggles, let's pull up inflation versus wages. And you'll see this chart. You'll see this chart over and over again. If you go look at charts, you'll see a recurring theme. This is the one I want to focus on. Gosh, why can't I just look at this without it having to go to, I'll tell you what, let me do this. Without having to go to a website. I don't understand why when I click on that, it's got to go to a website. All right, let me do that, and then do this, and then do this. Okay. So what you'll notice about this chart, and it's always the same. you can go look at a number of charts and they all look this way. So our money was still silver. If you go back and find like a 1965 coin or whatever, it was silver. Even it had silver in it. Even though the minimum wage just only had $1.25 an hour, coinage had silver in it. So there wasn't a lot of inflation happening here. But right about here, this is 1971. Look what happened. So this is what's causing the wealth gap, by the way. There's this separation between productivity and compensation. Before, when we had real money, productivity, compensation would track productivity, which makes sense if you think about it. If I buy a big machine and I hire somebody to run the machine, I can produce more and more out of that machine, which then allows me to pay the person to operate it more and more money. If I'm doing more manual labor type things, productivity doesn't go up and wages stay low. But if I can employ capital, that's what capitalism is. It's combining capital with labor to increase productivity. But what you see here is productivity has gone up, but wages have stayed low. And this is a monetary phenomenon. So I wrote 77, I meant 71. Let me just make that 71. This is a 7. So since 1971, you can see these have started to diverge, and they've continued to diverge. I mean, look at the difference now. And so if you're hanging out with your friends and you're talking about the wage gap, or the income gap, or the whatever they call it, the wealth gap comes up, well, then you'll know what to say about it. Okay. No, I don't want to save that. Let's X out of this, close that. So go study those charts. Go look at a bunch of charts and you'll see they all look the same. 1971, they started to diverge. All right, so here's gold. Again, it's likely that gold's going to come down here, but we don't know if we're going to be able to buy gold or anything. So, you might have to make some decisions about acquiring gold at a price that you believe is higher than what it will be. So just keep that in mind. Same thing with silver. We're likely to see a spike in silver. I don't know if we're going to see a spike in silver just yet. I don't think it's going to get this high, given that gold's already moved as far as it has. If you go back to gold's move is about over. You zoom in on this. I mean, it's about where I drew the line, so it's about done. It might get up here to 1550, but for the most part, gold's done. So I wouldn't expect gold to go much higher. And same goes for silver. Now, silver might spike in here somewhere, and maybe it gets to this, this little resistance area, but I don't think it's going to the second one. But we'll see. You never know. All right, the euro. You can kind of see what the forecast is for the euro. This was a 1, 2, 3, 4, somewhere in here 5, and then we got this first wave up, and then we got this really weird, I guess, wave 2. Let me switch over to the euro over here, and you'll see I've nipped and stuffed at the euro several times here, and I'm just trying to get in somewhere where I feel good about where the euro is. And I got a little curl starting to happen here on this MACD. This it's not really a MACD. It's something that Steve Griffiths creates. But what I've noticed is when this starts to come down, okay, and this starts to curl up, you usually get a big thrust. Where this crosses above here, you get a big thrust in this histogram. Starts coming up here where the market internals are coming down, and then you get this big punch out. It's almost like a squeeze. So I'm looking for that to happen. So somewhere in here, I mean, we might get a little bit of a pullback in the euro. this may be the low though. So I'm looking for maybe another week's worth of confirmation. A lot of times I use the 4 hourly for entries, and you can see right now it crossed up here, which would have been a good entry, but then it kind of crossed back down here. So I'm looking to see if it crosses again right here. I'll probably go ahead and enter the euro. So that's that on the euro. We can look at the US dollar, Canadian dollar. Anything with the US dollar in front of it, I think the US dollar is going to be going down. So that probably means that the US dollar CAD is going to be going down, although not as much as some of the others. And then the GBP US dollar, with the US dollar going down, we should see some increase in the Great British Pound. In fact, that may be already going on. Nope, not yet. It's not going on yet. But this may just be about done. And this probably about the time we get an announcement for Brexit, we're probably going to see the UK leave the European Union, and you're going to have a big spike down, but then it's going to be just like when Trump got elected. It's going to be a big spike down, and then it's going to rally back up, and it's never going to look back. That's probably what will happen. Oil, we've had a recent sell-off in oil. Let me go back to a weekly. Kind of, we've had this move in oil, but it's since been selling off. It should work its way down to this lower line, or at least this zone here below this pivot. That's what I'm expecting to happen. So we should get some relief in gas prices, which would be great. Great for I don't know about great for the economy, but great for consumers. So, all right, everybody, that looks to be about it for this week. Again, wanted to come on here early. Got a busy week. Son's going to be going to college in about a week and a half, and got a lot of things to do. So just want to come in here and go ahead and make this video. Hopefully those of you that are interested will go ahead and view it. And if you have any comments, leave them in the comments section. All right. Thanks. Bye-bye. Hold on. This didn't stop.